how would we spend 50 grand? But I thought I would ask a friend of ours and get a real good idea of what they would do.
Who's your friend?
Chat. I actually said, look, act as my investment manager and give me two strategies. One that's 10 out of 10 risky and one that's 5 out of 10 medium risk. Way more intelligent than any human on the planet. So that's the beauty of asking the question.
More data.
Yeah. Why pay a St James's Place broker
Yeah,
when you've got chat at your
screwed,
doorstep?
aren't
Yeah, and this is not just any chat. This is the paid version, the 4.0. So you're getting the good gear.
You're getting £30 a month worth of
getting the real high
advice.
quality.
I would look at his investments at my age, have fun with it. Like, I've got to be into doing it. I've got to have fun.
You're going
with it.
growth shares, aren't you?
I'm going growth.
If you're 60, you're never going to hit that. You're never going to be that 10 out of 10 person. But if you're 40 and the 50k is money that you can afford to lose, you're gonna root towards the 10 out of 10.
Welcome to the Investors Corner podcast. We've got a fun episode planned because Mike and Andy have no idea what we are about to talk about and why I've got my laptop open. So, boys, are you excited?
Very.
Buzzing.
Yeah.
Why change the
Can you
habit of a
tell
lifetime?
by
I never know what we're going to
The
talk
tones
about.
of our voices that we're...
Andy's had a
ready
tough
to go.
afternoon, Ian, I think.
I'm
Bit
looking
of a
forward
headache.
to it. I'm excited. I'm in a funny mood. I'm going to have a funny half an hour.
Oh, God.
It could happen on this podcast. So stick around. So, gents, we did a podcast a couple of weeks ago where we decided, we put a lot of preparation into it, actually, where we kind of said, how would we spend 50 grand
Yep.
with the view of trying to maximise the returns over 5 years. And a lot of people watched that episode. A lot of people have mentioned it to me. A lot of clips were taken in an interesting way on various social media channels. Good old video editing. But I thought I would ask a friend of ours and get a real good idea of what they would do with the same thing. So I thought I'd keep the theme going.
Who's your friend?
Chat. Chat. I was interested.
We love
So
chat.
the
I thought you'd
instruction...
WhatsApp Warren Buffett. But on this,
This is where chat went, and that's the instruction I gave it. No, I actually said, look, act as my investment manager and give me two strategies. One that's 10 out of 10 risky and one that's 5 out of 10 medium risk on investing 50 grand. I'm English and English based because I wanted it to stay away from the Americanisms. And then I haven't read it. I've jumped straight on the podcast and hit record. So let's get stuck in. So, the preparation's quite detailed actually in how it's given it to me. So I'm going to start with 10 out of 10. Are we okay with that? High risk strategy. Chat has said on the high risk strategy, they put 25 grand, a full 50% into growth stocks. And it means growth stocks around tech, AI and clean energy. Reason behind that, high growth sectors such as tech, renewable energy and AI, they're volatile but potential for significant gains. And if you focus on the Nasdaq 100, then the individual UK-based tech and biotech stocks could provide an excellent upside. Historically, it says growth stocks have yielded around a 15 to 20% per year in a bull market, but obviously they can be highly volatile.
15 to 20%?
In bull markets.
Right.
So in solid markets. But over 5 years, I guess if you had a good run, let's say you got 15% over the first 2 years, then that's some nice compound growth on the 25. We said stocks, but it's gone a little bit more detailed because obviously it's AI and it's way more intelligent than any human on the planet. So that's the beauty of asking the question.
more data.
Yeah. Why pay a St James's Place broker
Yeah,
when you've got chat at your
screwed, aren't
doorstep? Yeah, and this is not just any chat. This is the paid version, the 4.0. So you're getting the good gear.
You're getting £30 a month worth of
Getting the real
advice.
high quality stuff here.
Yeah, I think we said before, didn't we? Tech, AI, around those when we were discussing on the previous podcast. I think that's pretty sort of safe to invest your money in because everything is leading that way. Everyone's talking about, tech and AI. So, I mean, renewable energy, not too sure.
Do you know, it's actually even said, it's actually giving you a tip.
Oh.
This is not advice, as I just say it out there. But it said, consider individual UK growth stocks like Darktrace and Ocado for tech exposure.
Oh, so it's naming them.
It's actually naming them, yeah. Anyone know what Darktrace is?
No, it sounds
No,
shady.
but it sounds
Sounds dark
Sounds-
webby,
yeah.
but it's tech based. So I don't know quite what we got going on there. Number 2, Andy, a little bit up your street. What do you reckon?
Crypto.
Yeah,
Nice.
It's suggesting 30%, so 15 grand. Type Bitcoin, Ethereum, and altcoins. Reason: cryptocurrency markets are highly volatile, but have historically produced massive gains. Allocating a large portion here could significantly boost overall returns, although the risk is high. Strategy: invest in established assets like Bitcoin and Ethereum, with some exposure to smaller, higher risk altcoins such as Solana and Polygon.
Yeah.
Which I think is exactly what you said, to be fair, in the crypto.
Yeah, exactly. It's the
strategy.
smaller coins where I think you're going to get the bigger returns on. Bitcoin and Ethereum have been there for a long period of time. Some say that the boat may have sailed on those, but you could just get a nice, return from that. But if your strategy is to gain maximum returns and try that route, then it's just smaller altcoins that you can buy for £1 or $1 or $2, and then hopefully see those go to $10, $15 at some point, and that's where your big reward is. I met a person recently out showing a property actually, and said that the majority of his savings money is in crypto at the moment, and his purse was about £270,000 that he's got in crypto, and he said he started off with 20 grand in
not
there,
bad,
and
is
over
it,
2
eh?
years he's built that up to that level.
Yeah.
So although it's higher risk, returns are massive if you can do it correctly.
Does he own any digital monkeys?
No, he doesn't own digital
No
monkeys.
NFTs. Okay. Did you guys see the protest on the roundabout down the road on Monday as we came into the office?
No.
Did you miss it? That's because
Yeah.
I get in later than you guys.
Yeah.
2 guys
That's
on the
fine.
roundabout, 3 signs. One said, "Digital money is the government controlling your finances," and the other one said, "COVID jabs kill people." I don't know
Oh,
which
so very
person was
mixed.
supporting which
Yeah.
protest, but
Yeah,
I don't
and-
think they quite knew which one they wanted to
Well,
protest about.
obviously, protests in Bracknell get worldwide attention too.
There's just 2 guys,
So-
guy and a woman on a roundabout.
Yeah.
No police. Honk if you agree, or something like that was the sign.
Nothing else better to do.
Yeah, it was pretty big. So
But the digital currency thing, I still think at some point further on down the line we will be dealing with digital currency.
yeah,
I
okay.
don't think there'll be handheld money.
Well,
Or
I
there'll
think
be less of it.
we spoke, didn't we, about or you'd spoke to an accountant or someone about the fact that a lot of people were trying to leave the country on a podcast we recorded recently, and I guess if the Dubai sort of scene becomes very strong and significant and very multinational, which it already is, then that's where a lot of the oomph for the global kind of crypto strategy could come from, I would have thought. So we've got 10 grand left on this high risk chat investing strategy. These 2 we did not say.
No, with this is if you got £10,000 after investing in crypto and tech stocks, this is going to be your Hail Mary, isn't it?
Actually, I think, well, based on that, it said potential returns 100% on the crypto. I think that was the Hail Mary. These ones are a little bit safer, actually. These are the keeper and the defenders of the five-a-side team. They're trying to just mop up at the back. Peer-to-peer lending, 5 grand's going into platforms like Funding Circle or a rate setter. Peer-to-peer lending offers high potential returns, is better than traditional savings, but it also comes with credit risk. It's saying 5 to 12% per year, depending on the borrower profile and the platform. Strategy: spread the investment across multiple projects to diversify risk. Peer-to-peer lending. The other one is in theme with that a little bit, is property crowdfunding. So again, kind of putting the money in people's hands rather than an algorithm, shall we say. Platforms like Property Partner and Brick Lane effectively means, you own a section of a property or a portfolio.
Brick
rather
Lane?
than Brick Lane.
Oh, Brick Lane.
Brick
You said
Lane, yeah.
bricklaying. I was like, huh?
Don't know how much crowdfunding is in that. But yeah, that's quite interesting that it's thrown 10 grand at those 2. So peer-to-peer lending.
Haven't really heard much about peer-to-peer lending or
Funding
property
Circle's big, isn't
crowdfunding.
it? Funding Circle's the big one. I've heard of that, obviously, for its PR strategy that it puts out there. And I think a lot of younger people have started talking about this sort of stuff too.
Okay.
Yeah.
Alternative banking, I guess, isn't it? And it works for both sides. If you need capital and you've got a really, really investable idea. I guess we were thinking down the idea of actually invest directly into the business. This is the same but different in a sense.
My brother's company invested 6 figures into like a crowdfunding property investment block in the Midlands. There's like it was effectively a build to rent company that set it up. They're all let out, and then it's owned by property crowdfunding effectively. So loads of different investors have popped in. So the portfolio is run, managed. Obviously, it's got equity growth. It's got its own yields, and then payments and dividends come out on margins at the end of the year based on how much rent they've got, etc., etc. And it makes decent returns. This says 6 to 10%. I don't know whether it's that, but it's definitely above inflation levels. So, that's the 10 out of 10. How are you scoring that? What do you feel? Chat? Not bad, right?
Not bad.
Yeah.
I guess
we discussed two of the things, right? Literally all of us in the previous podcast had the same sort of thing going on. Maybe you two, not crypto, but sort of saying that what we were saying.
It's forecasting
so maybe we're
15.
Just as intelligent as chat.
It's forecasting 15 to 20% annual return on that investment.
And that 10 out of 10, that's more of a financial advisor scale than me, you and Andy scale. Because my 10 out of 10 risky investment is put 25k in the Omaze draw.
I thought you were going to say on black. I thought you were going to say on black then.
25k on the Euro Millions. That's like 10 out of 10 risk.
20 grand on red 7, one spin. Let's do it. Yes, please.
So that's a more measured scale. That you would go through that analysis with a financial advisor when you're looking at your pensions and investments. So, yeah.
Well, here we go with medium risk strategy. 5 out of 10. So number 1, 20k, 40% index funds and dividend stocks. UK FTSE 100, global index funds and dividend stocks. Reason: provide diversified exposure with low volatility than individual stocks. Dividend paying stocks also offer staple income, and I guess it's put that in because we're saying we want the turnaround in 5 years. Potential returns looking something like 6 to 10% year on year. Example of a good place to go is places like Vanguard, iShares, UK Dividend EFT, and it says for income from a UK blue chip stocks. So some solid sort of detail on that as well, which was quite cool. I've obviously done a few prompts to get it to this sort of strategy, giving us the basis of what we did on the podcast. Thoughts on that? 1 versus 1. Would you feel more comfortable going on these growth stocks like this tech IA-led stuff? Or would you be more comfortable putting, it says 20 versus 25, let's call it 20 grand more into the index funds? What would you guys do?
It comes down to your age and what that 50k means to you, doesn't it? And that's what we were talking about 2 weeks ago, is if you're 60, you're never going to hit that. You're never going to be that 10 out of 10 person. But if you're 40 and the 50k is money that you can afford to lose, you're gonna root towards the 10 out of 10. I did that rate yourself out of 10 test with a financial advisor a couple of weeks ago. Actually, I came out about 7.5 to 8.
What, on risk? Interesting.
Because I'm confident in how my business is performing. I've got capital to invest, and I'm in his eyes. I'm young. Told me I was young. So
who's going to win?
I think he was just trying to get my business.
Your wife on the house-related stuff that you want to spend the 50 grand on, or the investor?
Oh no, well, right now the house is winning.
Always the wife.
Yeah.
Always
but
the wife.
I'm tallying up my return on investment on the house.
What about in your age, Andy? Now you're 48. What are you thinking?
36. I think for me, I would look at his investments at my age and have fun with it. Like, I've got to be into doing it. I've got to have fun.
You're going growth shares, aren't you?
I'm going growth.
Yeah.
I'm going growth, and that's just because, I want to be excited by it. I think if I put my money into something where it's a good return but minimal, I just couldn't get myself into that. I couldn't have fun with it. I couldn't concentrate on it as much as I would with the growth ones, and seeing potentially if they do go high growth, that's what's going to excite me, and that's what's going to get me going on it. So yeah, all my funds would go into growth.
Interesting.
Or I could mix it up. I might go 2 growth, 1 medium risk, so I know that I'm sort of safer with that investment. But yeah, the majority of it would go into growth.
This medium risk has got no crypto, by the way. None in there at all. Interesting. Number 2, back on property, real estate investment trusts. So examples in the UK would be things like Land Securities Group, British Land, and effectively this is where they would be putting 12.5 grand into a portfolio, offer exposure to the property market without direct ownership. They provide liquidity and regular dividends. So you're looking at a 4 to 7% return year on year, including dividends. So again, it's focusing on looking at investments that are going to give you some sort of returns annually, as well as obviously some growth. So that's property led. It's quite interesting that it's done that on both, actually, because it's not really obviously for us, we wouldn't feel comfortable investing in property outside of our own judgment because we're in property. Yeah. But for the average person that maybe doesn't have 150 grand to invest and does have 10 grand to invest, it's not a bad strategy because it does keep it in tune with the property market, which we said is a staple of the investing kind of platform in the country, really. So yeah, thoughts on that, Mike? What do you reckon? Tempted to ever throw a couple of quid at one of these sort of REITs as they're
I mean, you go into one of those and they own 15,000 units, so they're basing everything on averages. So if they can get a 90-something% occupancy rates and blah blah blah, I always wonder, and again this is down to size and scale, is a lot of them buy enormous buildings. You look at Wembley Park, for example, they're generally sort of real estate investment trust buildings. Are they heading for like a massive profit hit at some point when 5 years' time the whole thing needs ripping apart and rebuilding? Or, do they have to hit a certain scale where that refurbishment of 400 flats, because every kitchen and every bathroom's the same size, doesn't even touch the sides, or what, really? I can see exactly why it is, because like I say, liquidity is great. You can go in, you can go out, which you can't if you just own one buy-to-let, and you can't buy a buy-to-let with 12.5 grand that I'm aware of anywhere in the UK. Not anywhere you'd want one. That'd be amazing. I'm sure you can find one.
Yeah, I'm sure.
Some dark areas.
How far up you're prepared to go.
Some weird Welsh mining village or something. But would you want it? So I get it, but I also have this weird nagging doubt that they're being managed by asset managers rather than individuals who are just paid a basic salary, don't really care.
That's what would concern me about putting money into something like that, is that you've got those side people on how it's being managed, and effectively they're controlling it and then passing on whatever comes of it. That's the only thing that I wouldn't like. I don't know who those people are.
Yeah.
I could say the same thing about crypto and stocks and shares. People running those companies.
Yeah, absolutely. The people who run funds in stocks, you look at the performance of them, and you're like, you'd be better off with no one running it sometimes.
But I think I'd have more confidence if I was investing in Apple or Meta. Mm-hmm. You'd have more confidence putting your money into those rather than things like that.
Yeah,
that's just my opinion on it.
Number 3, 10 grand's going straight into bonds, UK corporate bonds or bond EFTs. Reason bonds offer more stable, they're low volatile, making them a safer part of the portfolio. Bonds provide 2 to 5% per year. Not overly exciting.
That's not
exciting. No, I mean,
you excited, is it?
In theory, bonds should really start performing from this year onwards, where they haven't for the last couple of years because of the way interest rates have been. So they should actually start doing okay. But bonds are for the cash under the mattress kind of. I've made my money. I now need to keep it safe. Generation. There's a long title for a generation. But not for a...
It's not a hashtag.
No, it's not one of the best. But it's not for someone in their mid-30s who's looking to grow, aggressively. It's right. I'm 65. I've made my money. I've checked out. Bond is now a good place to hold it, right?
Safe, yeah. In terms of what we're looking at here, it's probably the safest of all of the 8 that I've read out so far. 5K. 5K is getting slapped into peer-to-peer lending. Obviously mentioned in the last one, returns 5 to 7%. Funding Circle is a platform that's been suggested on here. Small business, it obviously diversifies across, multiple small business loans.
Yep.
And you're kind of banking on these businesses becoming a success. Would you say, based on potential budget issues, that maybe that is more risky because small businesses that are about to launch, that are taking these loans at the moment, are potentially strategizing on the tax and profit forecasting that's about to potentially change? So maybe you would hold on that, or would you feel across the...
It's not necessarily launches, it's those looking for funding rounds.
Yeah, of course,
and an expansion of already successful businesses, isn't it? In that sense. So it's for 5K, number out of 50, isn't it? It's only 10% of what you're looking to invest. So I don't think I'd shy away from it based on the budget. Otherwise, you're going to shy away from everything based on the budget.
Got $2,500 left. What do you reckon?
I can't believe the word ISA. I can't believe the word ISA hasn't been mentioned in a 5 out of 10 risk thing.
Number 5, ISA.
Winning.
Hey. High interest savings account. Keeping some cash in an ISA. Looking at a 3 to 4%.
A cash ISA, not even a stocks and shares ISA.
Yeah, keeping it in a cash ISA.
That is safe. Yeah.
It's there for emergencies and capital protection.
Tax free. And all
use
that.
this as a safe net and an opportunity to benefit from rising interest rates, which potentially is not the case now. But so that's quite interesting. It's moderate. We're looking at a 6 to 10% potential consistent growth year on year. It's summarised between the two. Both strategies aim to maximise returns, but the high risk approach is designed for those who can tolerate potential business losses, while the medium risk portfolio is for those seeking a safer balance between growth and stability. So again, it might go down to the age bracket that you were talking about.
It's a big reason that people's risk changes, isn't it? Because if you're 60, you haven't got time to make it back because you don't have your own income anymore, or 65 or 70, whatever the date is that people retire these days. But at 35, 40, you've got time to make it back if 1 or 2 investments just don't go.
What I would love to do now is to get a wealth advisor or an investment advisor to come on the show. We've now got 5 profiles of 50k investments, 2 from chat, 1 from you, 1 from you, 1 from me, and not tell them whose is whose.
See which one.
But give them a little bit of research prior, someone that we know doesn't necessarily just listen to the podcast, so or podcasts in general, maybe an older chap.
Or lady.
Or anything in the middle. And then we can basically get them to score them. That would be quite an interesting exercise.
I'm pretty sure mine might.
And is a 9.9.
Pretty sure mine will be the highest risk out there.
Oh, yeah, okay. If Austin was scoring it.
Well, yeah.
And we may get Austin to score it as well, who is our apprentice video editor, potentially video editing this. So, yeah, that would be my next kind of strategy around this, because I think it's got legs, this 50k investment. We've also got a series coming up soon, haven't we, Andy? Should we tell everyone a little bit about that series?
Yeah, so it's probably going to be about a 6-part series, but we've had heard a lot of talk out there from young people that want to get into property investing.
In
saunas. I'll let Ian tell you that.
He's hanging around with the young kids in saunas. Yeah,
having a chat.
It's not weird.
2 lads.
Anyway,
I've got a very approachable face. I don't know why. People just talk to me in saunas.
Yeah. But yeah, they were mentioning about property investing and they don't know where to start. They've been watching, social media videos about how to do it, where to start, sort of process from start to finish and how to get it over the line. So that's why we sort of talked about, well, let's go out there with a series and tell them how to find a property, what to do to buy a property, what you need in place, how to use that property as an investment, what the returns will be and how you make it work for you financially further on down in your
Yeah.
in your life. So it's going to be a good series.
Yeah,
Lots of info.
We do the podcast every Friday, but this will be a season within the podcast from an audio point of view. So if you want to listen to that, make sure you hit subscribe on Spotify or Apple or anything else you listen to. But we'll put it as its main kind of source is going to be the YouTube playlist that we'll create for it. So all of the videos and the podcast for this particular show, the Investors Corner, goes on the Avocado Property YouTube channel. So if you're not subscribed to that and you want to go and check that out, there's also various property market updates, advice videos for landlords, buyers, sellers and tenants. You'll be able to find that on there as well. So yeah, if you are that wealth or investment advisor and you would like the task of ranking these 5 profiles, well, we were going to try and keep it secret, but if you're listening to this podcast, you know which these 2 are because we've just done it. So you probably won't be selected, but do reach out. Next week, what have we got coming up next week? What guests are coming up soon, Andy?
So we've got Claire from Soteria Planning, who's going to talk about wills, LPAs, trusts, and how to protect your assets. We've got Peter Licorinos coming back on about HMOs. He's got a special guest coming with him as well. So that'll be a good one.
I think his guest is an expert in kind of staging and maximising rents.
Yeah.
So it'd be quite interesting to hear some tips from her.
Exactly,
actually.
we haven't sort of covered that yet. And then we've got a property investor coming on called Milesh, who's got a personal story behind him and why he went into property investment, coming from the corporate life. So lots coming up, lots of exciting things going to be discussed. So yeah, stay tuned in. Stay tuned.
Hit subscribe. We're back next Friday. Andy, Mike, thank you very much.
Thank you.